Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Debt Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. Last week we spoke with Ross Walker about the Bank of England and their outlook, as well as the implications for market rates, where we now see 10-year gilts heading to 1.6% from 1.35%. And I discussed the ECB a bit as well. But one thing I need to follow up on when it comes to ECB is one of the topics in the markets of this week, which is fragmentation. And by fragmentation, I refer to the idea that if the ECB more quickly reduces purchases, moves to tighten policy faster than expected through the policy rate or both, what this means for both peripheral sovereign bonds on outright yield as well as on spread. And for example, if we use Italian bond spreads, should they widen and move higher based on either the simple supply-demand dynamics when the ECB purchases less, or on the idea that if you have higher yields, does that raise questions about debt sustainability for large indebted countries with historically and relatively low growth? So tackling the latter issue first, we do not have debt sustainability concerns, as the growth and financing situation in these countries is not concerning. It's especially helped by the fact that the last few years, low yields has been given them the ability to finance a lot of that debt at lower levels, as well as just an overall positive growth outlook. When you think about supply demand with the ECB stepping out, yes, that we think that will create some pressure. But as the ECB reminded us this week with various speakers, they still are going to have various programs where they can skew purchases to, say, Italy or other peripheral nations if there's pressure on that. And they've also raised the possibility of taking further actions if things get out of hand. Now, all that said, we do recognize that there is a carry dynamic here where years of investors buying higher yielding assets, and in this case, I mean both European sovereigns and European credit, proceeded with an expectation of no ECB policy changes for the foreseeable future. So we're shaking that tree this week. And I'm a bit suspicious that you can clear out years of this kind of carry and position buildup in just a few days. So while we think these dynamics long-term shouldn't be a major issue, in the near term, there could be some additional volatility, some legacy unwind, some position profit taking in things like periphery and even European investment grade credit. So that's the rates and a bit of the credit side of things. But I also want to cover how all these dynamics are impacting our FX views. Before I do that, I have to note that just a few minutes before this recording, we had another US CPI report beat expectations, and the US core inflation is growing at a 6% year over year rate. Now, this may be peak, but it's still awfully high. This has yields moving higher again. The speculation now, the Fed may need to hike by 50 basis points in March. At least that speculation is rising. So there's an awful lot going on. And this is where I'm going to bring in Paul Robson, co-head of G10 FX Strategy. All right, Paul, you heard all that, but just even as a refresher, we've had the hawkish Bank of England last week, hawkish ECB. This is all on the heels of a month of hawkish Fed and now a strong US CPI. What do you make of all this?
Well, it's certainly been an interesting couple of weeks, hasn't it? In fact, it's been a fascinating sort of start to the year. And I think for currencies, it very much plays this idea of monetary policy dominance as a theme or a driver of currencies. If you think about the pre-pandemic era, it was all about monetary policy. We went into the pandemic, it all switched very quickly into sort of fiscal policy, which governments could spend the most, support growth, capital followed that growth. But as we exit the pandemic, or a large part of that in terms of the macro impact, it's monetary policy dominance that I think is important. So of those three central banks that you've mentioned, I think the ECB is the one that I find most interesting. If you think about the Bank of England and the Fed, they're pretty much on preset tightening path. So the Bank of England has raised rates. It's telling us it's going to continue to raise rates, a little bit more nuanced, maybe a little bit more sort of front-loaded tightening. It becomes a little bit more data dependent later. And as you quite rightly articulated about the Fed, strong inflation numbers, Fed's obviously signaling it's going to continue, and there's no reason to doubt that. For the ECB, it was a little bit more nuanced this week. So you've had Lagarde, you've had Villeroy, just pushing back a little bit more on sort of more hawkish sort of consensus view for the ECB that they're going to raise rates by the end of the year. They've been stressing that an inflationary shock, the first round effect, doesn't necessarily lead to persistent inflation. And I think is a sort of theme that's emerging is this idea of a cost of living shock. And ultimately, it hurts household disposable incomes, and it's actually deflationary or disinflationary. And they can go a little bit more slowly, be a little bit more data dependent. So you take those two angles from the ECB versus the other two central banks, and it just gives us confidence that we haven't seen the lows yet for this year in euro dollar and for euro sterling. So we think both of them continue to trade lower in coming weeks.
That's a really interesting perspective. I mean, I have thought myself that looking forward, what's the next story? Okay, we've got inflation. That's certainly it's a story that has legs, but is there a growth angle to it, right? Do we start worrying now that with central banks tightening, and as you say, perhaps, this is impacting on household spending power? Is the next story going to be some sort of growth concerns that may, shift markets? Probably too early, but, your comment there adds another kind of interesting layer to that. So, all right, away from the major central banks, what about your squeezed middle? We've heard this before about, those that either markets or the actual banks themselves, central banks themselves need to catch up. What's the latest on that squeezed middle, as you put it?
Well, we actually had a fair few updates. This obviously the focus very much on US CPI and the ECB, but we had the Riksbank. Riksbank, we think, are one of the central banks that might just get squeezed into having to change their guidance. And actually this week, they were really dovish. I mean, their projected rate path shows a hike at the beginning of 2024. Markets are speculating that the ECB is going to be tightening at the end of this year. So that's a very sort of dovish signal. We think the CPI numbers that are coming up, I think on the 18th of the month, inflation expectations, Riksbank super sensitive to that. But ultimately, we think that the guidance will have to be shifted by the Riksbank and fading rallies in Euro stocky and actually trying to build positions in long trade weighted stocky, I think is a good thing. The Bank of Japan also on the wires this week, and they're a central bank that we think are right at one end of the sort of policy central bank dominoes, as we've sort of started to call them. The central banks that are sort of saying they're not going to be tightening, they're not tightening for some considerable time. But as you say, as people look to the central banks that are now fully priced, obviously there's going to be more interest in whether those central banks will start to move. And this week, again, another dovish signal. So the governor saying that they don't think it's the right time to move away from easy policy, and they're going to defend their yield target with sort of pretty unlimited money. So that just, we think, is just too early to start looking for the turn in the yen. Other central banks that we're really focused on, the RBA, I think that their sort of patience guidance is untenable. Bank of Central Bank of Canada, they should be hiking already. I don't know why they delayed, and I think that ultimately will come through as well. So, watch that squeezed middle. I still think it's the sort of maybe the number two thing for currency markets for this year. The first one being this idea of leadership in a monetary policy divergence is a major thing for currency markets.
Excellent, Paul. Thank you so much. All right, everybody, that's it for this week. Next week, we're watching the latest minutes from the Federal Reserve. It was the January minutes that kicked from the December meeting that kicked off the global rates move. And this will be the minutes from the January meeting. So we'll see just how hawkish or worried about the inflation outlook they are. Any sense of behind the curve could really get this 50 basis point momentum moving. We also have ECB's Lagarde speaking again. She tried to push back against some of that fragmentation from earlier in the week that I've mentioned, albeit not very successfully. So is she more forceful on that, or perhaps a little bit more dovish to take some pressure off? We'll see. UK CPI, UK employment, UK retail sales, Euro GDP, German survey data, still plenty going on. So it doesn't look like Paul or I are going to get much of a break. And I always, as usual, still have one eye on Ukraine. With that, we'll sign off, and everybody have a great week. Thank you. I hope you have enjoyed this episode of the Weekly Watch. please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.